Have you ever wondered how a small error in invoice preparation can ripple through an entire financial system? In today's session, we will uncover the vital processes behind managing accounts payable and receivables, ensuring that every invoice is prepared, verified, and recorded with precision. This guide is designed for finance professionals who understand that accuracy in financial documentation is not just best practice, it's the backbone of a successful and compliant organization. Before we dive into the complexities of invoice management, let's establish the building blocks: accounts payable and accounts receivable. Accounts payable represent the money owed by your business to third parties, suppliers, banks, or service providers who fuel your operations. In contrast, accounts receivable track funds that are owed to your company by your customers. Understanding this relationship forms the foundation of all accounting practices, and it is essential to maintain clarity and systematic organization from the very beginning. We start our journey with invoice preparation. An invoice is more than just a request for payment. It is a legal document and a record of the transaction between a seller and a buyer. A meticulously prepared invoice reflects your company's professionalism and safeguards your interests. Each invoice must carry a unique identification number to avoid duplication, along with your business name, contact details, and a clearly stated Australian business number if applicable. The exacting nature of this process ensures that all parties are on the same page, mitigating risks like miscommunication or delayed payments. Professional invoices should be crafted according to your organization's policies, featuring needed elements such as a detailed description of goods or services, proper dating, tax details, payment terms, and your brand's unique attributes. Consider the invoice as an artifact that links your sales history with regulatory compliance, legal protection, and effective inventory management. Keeping the design clean and uniform fosters a sense of order. Each section, from headers to itemized details, works together to make the invoice both legible and legally robust. Once your invoices are prepared, the next crucial step is the verification process. Accuracy here is vital. Any discrepancy can lead to far-reaching errors that affect your balance sheets and relationship with stakeholders. The first method of verification is by comparing the invoice against purchase orders, PO. A purchase order-based check involves matching the details of the invoice directly with the original order, ensuring that the amount invoiced corresponds with what was requested. In scenarios involving deliveries in parts, invoices must be verified against goods receipts. This extra step confirms that the services or products received match the invoiced amounts. In cases where a purchase order is not available, coordination between the purchase, accounts payable, and general ledger teams becomes essential to confirm legitimacy, preserving both transparency and accuracy. However, even the most precise processes can encounter errors. Imagine receiving an invoice with an incorrect recipient name or missing itemized breakdowns, seemingly minor mistakes that can throw off data entry and delay payments. Here lies the conflict, the need to swiftly identify and correct these errors while maintaining an atmosphere of diligence and accountability. Common errors include incorrect dates, miscalculated totals, and omission of essential details such as the company logo, which helps in reinforcing brand credibility. Every error discovered is not a setback, but an opportunity to fine-tune your internal controls and ensure that financial records stand up to the strict scrutiny required during audits and compliance reviews. When errors do occur, the guide recommends a systematic approach to their identification and correction. A thorough review involves cross-checking invoices against a series of source documents, purchase orders, goods receipt notes, and even adjustment notes if necessary. This diligent cross-checking plays a critical role in preventing fraud, verifying that all amounts are accurate and detail-oriented. Calculations need to be spot on. For example, when an invoice fails to include the necessary unique identification or proper itemization, a corrective action must be taken immediately to rectify the data, sometimes through an automated process, sometimes manually. Every stage in this error correction process reinforces your controls, ensuring that the financial records reflect an accurate picture of transactions. Let us now explore a practical example. Consider the case of Castle King P2I Limited, where the trial balance revealed discrepancies. The sales book was undercast by $10,000, and an additional $500 from accounts receivable was not correctly posted. The resolution came by crediting and debiting the respective accounts to rectify the omission, thereby restoring balance to the financial statements. This case study underlines that even when errors are identified, whether due to clerical oversights or miscalculations, systematic steps, when followed carefully, can restore integrity to your accounting records. With errors addressed, attention turns to the preparation and processing of journal entries. Journal entries serve as the official record that finalizes any transaction once the invoice details are verified. The process begins with gathering all invoice information. Each document should include the precise invoice number, date, amount, and associated accounts. The journal entry then follows strict guidelines. For example, a sales invoice will typically require a debit to accounts receivable and a corresponding credit to sales revenue, whereas purchase invoices might entail a debit to an expense or asset account with a credit to accounts payable. It is at this stage that the importance of properly classifying transactions is underscored. Every entry must be clearly labeled and entered into the general ledger to ensure that debits and credits remain balanced. Next, these entries undergo a systematic review. The process involves verification, ensuring that each entry conforms to both internal policies and regulatory standards. The entry is then authorized by a designated authority, often a finance manager or CFO, depending on the value and nature of the transaction. This check and balance system ensures that no single entry goes unreviewed or unauthorized, protecting the organization from potential risks and misstatements. If discrepancies persist after the initial entry, adjustments are made to reflect the accurate financial status. These adjustments sometimes involve contra-entries, where receipts and payments are offset against one another to simplify internal transfers and clarify final figures. For instance, consider a scenario involving ABC Manufacturing Pty Ltd and Eco Packaging Pty Ltd. Here, a series of transactions required the use of contra-entries to reconcile amounts owed. By subtracting the smaller debtor balance from the larger creditor balance, the final contra amount is established, ensuring that internal transfers reflect the true financial scenario. Similarly, an adjusting entry may be necessary when discrepancies arise from mischarged amounts. In another illustrative example, if an error leads to an overcharged invoice, a corresponding debit and credit are recorded to adjust the mistake. Such entries not only correct the ledger, but also serve as a transparent record of corrections made, an essential mechanism during audit trails and internal reviews. Another essential aspect of financial record keeping is the secure and systematic storage of documents. Proper document storage spans far beyond physical filing. It forms the backbone of compliance and efficiency. Retaining copies of all invoices, journal entries, adjustment notes, and other supporting documents is not just about staying organized. It also ensures that your financial statements can be validated during audits, supports tax filings, and aids in future decision-making. Document retention policies are critical for compliance with legislative requirements. They also help in safeguarding sensitive financial data from unauthorized access, while ensuring that documents remain easily retrievable when needed. It is crucial to develop clear procedures for document storage. Businesses must address multiple aspects, including legal documents that must be preserved for regulatory reasons and administrative records that support operational decisions. For instance, keeping detailed files from past financial years can significantly impact decision-making, as historical data provides essential insight for setting future policies and budgets. The advantage of securing these records extends to both small and large businesses. In smaller organizations, manual or spreadsheet methods may suffice, whereas larger operations might leverage automated software systems to secure data efficiently. Now, envision a scenario where vital documents are stored haphazardly in a cluttered room or misfiled in an outdated system. This disorganization can lead to missed deadlines, delayed audits, and even potential legal consequences if documents required by law are not readily available. Therefore, crafting a robust document retention policy, one that clearly stipulates methods for labeling, segmentation, and restricted access, becomes essential. Organized storage not only instills confidence among stakeholders, but also ensures that your company remains prepared for any internal or external audit. Before we wrap up, let us review the key lessons learned. First and foremost, understanding the fundamental difference between accounts payable and receivable sets the stage for all subsequent financial practices. Every invoice must be prepared with meticulous attention to detail, following organizational policies that enforce clarity, legality, and professionalism. Invoices are then verified with equal rigor. Any discrepancies must be identified and corrected swiftly to maintain the integrity of the financial records. Journal entry processing and proper authorization are integral in transforming invoice data into balanced accounting ledgers. Through detailed review and correct classification, every transaction is documented correctly, ensuring that what might seem like a minor error today does not turn into a significant problem tomorrow. Additionally, learning how to handle contra-entries and adjusting entries empowers accounting professionals to refine records that might otherwise be misleading or incomplete. Finally, comprehensive document storage practices underpin the entire system of financial management. Secure, organized, and accessible records not only facilitate sound decision-making, but also provide the much-needed backbone of compliance that today's regulatory environments demand. By keeping your documents in order, you ensure that your business remains agile, audit-ready, and resilient in the face of change. Through this step-by-step exploration, we have seen how the interconnected processes of invoice preparation, verification, error correction, and record keeping coalesce into a robust framework for financial accuracy and reliability. Each segment, from the initial creation of an invoice to the final archive of documents, plays a pivotal role in preserving the integrity of your company's financial records. As we conclude, remember that precision in financial management is not an option, it is a necessity. The steps discussed today not only mitigate risk, but also empower you, as a finance professional, to build a reliable, compliant accounting system. Always strive for excellence and continuous improvement in every process, knowing that each carefully verified entry and securely stored document strengthens your organization as a whole. Review your existing invoice and accounting procedures to ensure they comply with organizational policies and regulatory standards, and consider leveraging automated software for greater accuracy and efficiency.